You spent NT dollars buying a stock, and a year later only Lininins left. This isn't bad luck, it is because you looked at the wrong numbers right from the start. Here is how many people pick stocks. They open their phones, look at the stock price, feel that one stock is cheap and another is too expensive, and then place an order. Or they hear a friend say a certain stock is hot right now, rush in to buy it, and end up getting trapped. Have you ever felt this way? Watching the price go up makes your heart race. Watching it go down makes your stomach hurt, but you never actually know what you are buying. This is the fatal blind spot for retail investors in Taiwan. You keep staring at the stock price, but the price itself tells you absolutely nothing. A Wushi Dan dollar stock might actually be 10 times more expensive than a Wudinin Dan dollar stock. This isn't a riddle, it is the truth. Think about how many years you've been fooled by the stock price number. What I want to tell you today is that the most profitable long-term stock picking logic relies on looking at just two numbers. It's not about technical chart patterns, it's not about tracking institutional chip flow, and it's not about predicting where the big money is going. It's just two numbers that anyone can look up on a computer in 5 minutes. Yet 90% of retail investors have never understood what they truly mean. After watching this video, you will know how to judge whether a stock is actually expensive or not and whether it's worth holding long-term. You will learn the two fatal cognitive traps that Taiwanese retail investors step into most often, and you will walk away with a stock picking decision framework that you can use for the rest of your life. Remember this phrase, as it is the core of today's video: price reflects market sentiment, but value reflects the facts of the business. Making money long-term relies on buying the right facts, not guessing the right sentiment. You might think this sounds cliché right now, but by the end of this video, you'll want to screenshot it and save it. First, let's talk about how Taiwanese retail investors lose money. According to statistics from the Taiwan Stock Exchange, TWSE's the long-term profitability of retail investors significantly lags behind the broader market index. For many, the more frequently they trade, the more money they lose. This isn't because they aren't trying hard enough. It is because they are using the wrong methods. They are looking at the price, not the value. They are chasing the uptrend, not the fundamentals of the enterprise. Have you ever experienced this? You see a stock go from Ardinin to Seninin, think it's gone up too much, and don't dare to buy only to watch it continue up to Wudinin. Or conversely, you see a stock drop from Yaolinin to Wushi, think it's a bargain, rush in to buy, and watch it fall to Arshi. You've encountered both situations, right? Where is the problem? The problem is that your standard for judging expensive or cheap is fundamentally flawed. You are using the absolute number of the stock price, but the absolute stock price has no direct relationship with whether a stock is actually worth your money. This brings us to the first underlying rule we are breaking down today. Basic textbooks from Taiwan's financial regulatory sandbox, as well as academic standards for stock valuation, clearly point out to evaluate whether a company's stock is worth investing in. The core metrics to look at are the price Dan to Dan earnings ratio, FEI ratio, and the return on equity ROE. These two numbers are the core indicators of whether a stock is expensive and whether the company makes money, not the stock price itself. The standard definition of the P/FEI ratio is the market price of the stock divided by its earnings per share EPs. In plain English, if you buy the stock at its current price, how many years will it take for the company's earnings to earn back your investment? A stock with a P/FEI of X means that, in theory, it will take years of profits to make your money back. A P/FEI of X means years. So for a Wushi dollar stock where the company earns $E per share, the P/FEI ratio is X. For a Wudinin dollar stock where the company earns $Wushi per share, the P/FEI ratio is only X. Which one is more expensive? The Wushi dollar one, of course. Do you understand now? The stock price number has been deceiving you for years. So what is a reasonable P/FEI range in the Taiwan market? According to historical TWSE data, the average P/FEI ratio of the TAIEX Taiwan Stock Exchange Weighted Index typically falls between X and X in the long run. If you buy a stock with a P/FEI far above this range, say X or X, you need to be extremely clear about what you are buying. The premium you are paying must be supported by ultra-high future growth, which means the risk is significantly higher. This doesn't mean you can never buy high P/FEI stocks, but you must know what risks you are taking on. Here is a trap that retail investors fall into most often. I'll tell you this one first, but there are deeper ones later. Many people see a low P/FEI ratio, think it's cheap, and dive in. But a low P/E ratio happens for two reasons. Either the market has undervalued the company, or the company's profitability is collapsing. If it's the latter, you are stepping into a value trap. It gets cheaper as it falls, but in reality, it is becoming more expensive. Therefore, the P/E ratio must be looked at in tandem with ROE. This is the second key number. ROE return on equity is standardly defined in Taiwan's financial education as net income after taxes divided by shareholder equity. In plain English, for every dollar of shareholder money the company uses, what percentage can it earn back in a year? A company with a 2% ROE means that for every $10 of shareholder capital invested, the company earns $10 back in a year. The higher the ROE, the more efficient the company is at using capital to make money. In Warren Buffett's stock jan picking logic, ROE is a core metric. Academic research also long supports that high jan ROE companies outperform the market average in long jan term stock performance. Local research in Taiwan, including papers from National Chengchi University's Department of Finance, has found similar results. This isn't a secret, but 90% of retail investors have never seriously looked at this number. What is a reasonable standard for ROE in Taiwan? Generally speaking, a Taiwanese enterprise that can sustain an ROE of over 15% long jan term is considered relatively high jan quality. Those that can stabilize at over 15% are incredibly rare. You can go to the TWSE's Market Observation Post system, MOPS, and directly look up the ROE of any listed company entirely for free. Now you know what the two numbers are, but knowing the definition isn't enough. You need to know how to use them together and the deeper logic behind them. Before we move on, let me ask you a question. Do you know the P/E ratio and ROE of the stocks you currently hold? Leave a comment and tell me. I'm very curious how many people have actually checked these two numbers. Let's continue to the second underlying rule. There is an ironclad rule in the Taiwan stock market that retail investors almost never face. In the long run, a company's stock price will ultimately revert to its profitability. In the short term, hype and market sentiment can push prices up. But what cannot be sustained long jan term are companies with continuously declining ROEs and deteriorating profitability. According to historical TWSE data, between Nansening Sen and Nansening Arsha Sen, the TAIEX grew by over 5%, but this growth was not distributed evenly across every stock. A group of companies maintained high ROEs long jan term, and their stock prices continually hit new highs. Another massive group of companies saw their ROEs decline year after year, and Arsha years later, their stock prices were back to square one. Or they were delisted. Which type did you buy? Here is an advanced cognitive blind spot that 90% of financial bloggers in Taiwan don't fully explain. This is specifically for those of you with some investing experience. Many people know to look at ROE, but they only look at a single year's ROE. They don't look at the trend. A company might have a 5% ROE this year, but if it has dropped from 5% to 5% over 3 consecutive years, that signal is more important than the ROE itself. The trend of ROE is the true early warning system. You need to look at the ROE trajectory over a consecutive 3 to 5 years, not a single Jan-year snapshot. This data is fully available on the MOPS financial ratio analysis page, but most people never click in to see it. The third underlying rule is the marketing logic of Taiwan's financial institutions, and how it causes you to ignore these two numbers. Have you noticed what brokerages, banks, and investment trusts in Taiwan say most often when recommending a stock? They say things like, "This stock is very strong right now. This narrative is gaining traction. Foreign capital is buying in." Or institutional chips are concentrated. They almost never tell you what the P/E ratio is, what the ROE percentage is, or whether the company's profitability is rising or falling. Why? Because trading volume is the primary source of income for brokerages. The more frequently you trade, the more commission fees they collect. If they told you to find a company with a long jan term high ROE and a reasonable P/E ratio, and then just hold it long jan term without trading frequently, their income would shrink. This isn't a conspiracy theory, it's the inevitable result of their business model. Regulations from the Securities Investment Trust and Consulting Association (SITCA) explicitly require financial professionals to disclose risks when recommending products, but in actual marketing materials, the risks are often hidden in the smallest text at the very end. This doesn't mean brokerages are evil, nor does it mean all analysts are lying to you. But you must realize that their commercial interests and your long jan term wealth interests are not entirely aligned in some areas. You must take responsibility for your own money. They won't. Let me repeat this quote. Price reflects market sentiment, but value reflects the facts of the business. Making money long Jan term relies on buying the right facts, not guessing the right sentiment. Now, let's do the math. Using real data from the Taiwan market, I'll show you exactly how big the gap is between these two stock Jan picking methods. Scenario Yi. The most common mistake made by Taiwanese retail investors. Suppose in 2018you spent 10,000 NTD chasing a very hot Taiwanese tech stock. Its P/E was over 45x, and its ROE was only 8%. But the stock price kept rising, and everyone was chasing it. Then the 2020 COVID-19 Pasaka endemic hit. This stock got cut in half, dropping over 50%. Your 300000S rank to 150000. What's worse, this company's row had already started declining in 2019. If you had looked at that number back then, you never would have bought at that price. By 2020, you finally couldn't take it anymore and cut your losses. Adding in trading commissions and securities transaction taxes, your actual loss was over 16,000,000. Your 10,000,000 turned into less than 16,000,000, and it took 4 years. Scenario R. The result of the correct approach. Let me state the prerequisites clearly first. Suppose at the exact same time with the same 10,000,000 NTD, you chose a Taiwanese company with a strong economic moat. Its P/E ratio was in a reasonable 15x Fu x range. Its RO had been consistently above 5% for 5 years, and its profits were growing steadily. Such companies definitely exist in Taiwan. TSMC is the most extreme example, but it is not the only one. Food, finance, and tech industries in Taiwan all have companies that meet this criteria. You just need to spend time screening for them. This kind of company also would have dropped during the 2020 Pasaka endemic. You must be mentally prepared for that. The maximum drawdown could have been 20% to 10%, meaning your 10,000 unit GHT have dropped to 10,000. This is a real risk you cannot avoid. However, because the company's profitability didn't collapse and its row was maintained, the stock price fully recovered by 2020 and continued to hit new highs. By 2023, that same 10,000 would have grown to roughly 6,000 to 7,000 depending on the specific stock. The premise for this result is that you didn't panic Jan sell during the drop. The company's row truly held up, and you didn't buy just one single stock, but rather diversified across high Jan quality companies in a few different sectors. Scenario Sen, the long Jan term wealth gap over Arsha years, and the worst Jan case scenario during an extreme black swan event. The two most severe market crashes in Taiwan's history were the Liangchen.Jancom bubble, where the TAIEX dropped from 0.00 points to over 10 points, a 70% plunge that took nearly 15 years to break even, and the 2008 financial crisis, a drop of nearly 60%, taking about 2 years to break even. If, at the peak of 2000, you put 10,000 into a bunch of high Jan P/E, low Jan ROE internet hype stocks, many of them eventually delisted, your money might never come back. But if you bought traditional industry leaders or financial stocks that had reasonable P/E ratios and stable rows at the time, even though they plummeted just the same, their profitability didn't collapse. Eventually, they all broke even and went on to hit new highs. This is the true value of these two numbers. They cannot help you avoid market downturns, but they can help you avoid the risk of permanent capital destruction. Market downturns are temporary. The collapse of a company's competitive advantage is permanent. What you should fear is not a dropping stock price, but buying a company whose profitability is disappearing. Speaking of which, let me ask you another question. When you picked stocks in the past, what did you primarily look at? Price fluctuations or P/E and row? Leave a comment and let me know where you currently stand. Next, I'll share 4 ironclad rules. These are absolute prerequisites for using this stock Jan picking logic. If you don't meet these 4 conditions, you shouldn't use this method, or you need to make major adjustments. Rule Yi: the funds you invest in the stock market must be idle funds that you won't need to touch for at least 3 years. This isn't nonsense. It's the core premise. The longest break Jan, even cycle in Taiwan's stock history, was over a decade. If you buy a high Jan quality company, but the market tanks, you must have the staying power to survive the trough. If you are using money meant for a mortgage payment in 3 months or for tuition, any stock Jan picking method is high risk for you. This rule applies to everyone, no exceptions. Rule R: The stocks you choose must maintain a row of at least 10% for 3 consecutive years, and the trend must not be consistently downward. A high row for a single year doesn't count. You need sustainable profitability. If a company's row drops from 20% to 15% to 10%, even if it is still at 10%, that trend is a warning sign. This rule is especially important, but the prerequisite is that you have basic financial statement reading skills. Beginners can start by tracking the components of the Taiwan Wuxi Index, Lining Wurin. Rule 10. The holding percentage of a single stock should not exceed 5% of your total stock portfolio. This is the basic principle of risk diversification. It is not about being conservative, it is about being rational. Even if you find a company with super Zan high row and a reasonable PFA, a single enterprise can still face unpredictable black swans such as management scandals, structural industry collapse, or geopolitical shocks. Diversifying isn't because you don't trust the company, but because you know your own cognition has limits. This rule is especially crucial for middle and aged investors and retirees. Rule 6. You must conduct periodic reviews. At least once every 6 months, read and verify the ROA and PFI of the stocks you hold. A company's competitive advantage is not permanent. Many Taiwanese companies that were once considered premium have seen their rows drop significantly over a Wu to Shi Jian year span, and their stock prices lag the market as a result. You don't just buy and forget. You buy, and then you monitor whether the company's profitability is being maintained. This rule is the most frequently ignored by long Jan term investors and lazy dividend Jan stockholders, but it dictates your long Jan term results. Now, let's talk about a 4 Jan step 0 Jan barrier action plan you can complete today. Phase Step E. Open the TWSE Market Observation Post System. MOPS TWSE. Com2. This is a completely free official platform. Enter the ticker symbol of a stock you own or are interested in. Click on Financial Ratio Analysis. Find the Return on Equity column and look at the numbers and trend over 5 consecutive years. This takes 5 minutes, but the information it gives you is far more valuable than looking at a month of technical charts. Phase Step R. Check the PFA ratio on a similar platform. You can find this on the TWSE's daily trading info page, or just use a Taiwanese financial website like GoodInfo or MoneyJ. Search for the stock's PFA ratio and compare it to the average PFA of the TAIEX to judge if it is relatively expensive or cheap. Remember, PFA must be paired with row. A low PFA alone doesn't mean it is cheap. You must confirm if the row justifies that valuation. Phase Step 10. Build your screening list. Use these 3 criteria for an initial screen. E. Row over 5% for 3 consecutive years. R. PFA ratio, not exceeding E/Wu times the TAIEX average. Sen EPS for the most recent quarter has not significantly declined. The number of listed Taiwanese companies that meet these 3 criteria isn't large, but these are the ones worth your time to research deeply. If you're a beginner and don't want to pick stocks yourself, start with ETFs that track the broader market, like the Yuanta Taiwan, Wuxi, Lining Wurin. Once you build a foundation in stock analysis, you can gradually add individual stocks to your allocation. Phase Step C. Establish your periodic review mechanism. Set a reminder in your phone calendar for once every half a year. Regen check the row and PFA of your holdings. If the row drops by more than 3 percentage points for 2 consecutive periods, or if the PFA has far exceeded its historical reasonable range, regen evaluate whether you should keep holding it. This doesn't mean you should trade frequently, it means you should have the discipline to monitor company fundamentals. The trigger for cutting losses should be a fundamental change in the company's profitability, not short Jan-term price volatility. Now I'm going to share 2 advanced Taiwan Jan-specific pitfalls. This is the most hardcore part of today's video. 90% of Taiwanese financial bloggers won't go this deep. Advanced pitfall E. The distortion of row due to cross-stand holdings and reinvestments, which is unique to Taiwan. Taiwan has many conglomerates. The parent company's row might look beautiful, but if you read the financial statements carefully, you'll find that a massive chunk of their profits comes from non-Jan operating income generated by subsidiaries or reinvestments, rather than the competitive strength of their core business. This is extremely common in Taiwan's traditional industry conglomerates. According to Taiwan's FSC regulations, listed companies must disclose consolidated financial statements, Hebin Caibao, but many retail investors only look at the parent company's individual standalone statements. You need to develop the habit of looking at the consolidated row, while also comparing it to the core business's operating profit margin, confirm that the source of the row is sustained competitiveness in the core business, not one-off non-dan operating income or the sale of assets. This detail directly dictates the accuracy of your judgment. Advanced pitfall R, the impact of treasury stock, share buybacks on the P/E ratio. When a Taiwanese listed company buys back a massive amount of its own stock, the number of outstanding shares decreases. This naturally inflates EPS, which in turn makes the P/E ratio look lower. It looks like it became cheaper. But this doesn't mean the company's profitability actually improved. The denominator just got smaller. In recent years, several Taiwanese tech companies have massively bought back treasury stock, making their P/E ratios look very attractive. But if you look at their absolute total profits, there was no significant growth. The MOPS platform has complete records of treasury stock execution. When evaluating P/E, you must simultaneously confirm if the company is doing massive buybacks and whether the funds for those buybacks come from core operating cash flow or from taking on debt. This is a blind spot that even experienced investors easily overlook. Speaking of this, let me repeat the core mantra once more. Price reflects market sentiment, but value reflects the facts of the business. Making money long-dan term relies on buying the right facts, not guessing the right sentiment. Now let's discuss contingency plans for extreme market conditions. If the market experiences a systemic crash like in Liaotian or Liaotian Ba, and the high-dan quality stocks you hold drop by 40% or 50%, what should you do? Yi, confirm if you have strictly adhered to ironclad rule Fei Yi. Are your invested funds truly idle funds that you won't need for at least 3 years? If so, your first action is to do nothing. Continue holding and wait for confirmation of the company's profitability. R. During a severe market crash, read-and check the row of the stocks you hold. If the row remains stable during the crash, it means the company's competitive advantage hasn't collapsed. The price drop is caused by market sentiment, not a permanent destruction of corporate value. Historically, premium Taiwanese companies that maintained their row after the Liaotian Ba financial crisis ultimately saw their stock prices recover. However, many companies whose rows collapsed during the crisis still haven't recovered to this day. Sen. If you have extra idle funds, a market crash is an opportunity to scale into your positions. But the prerequisite is that you have confirmed the company's fundamentals haven't collapsed, and your funds are truly idle. Do not borrow money to average down just because you think the stock is cheap. This is the most common reason retail investors suffer permanent capital losses during a crash. Su. If during a crash, you discover that the row of a stock you hold has declined significantly for 2 to 3 consecutive quarters, it means the company's competitiveness may be undergoing a fundamental shift. You need to regen evaluate whether to continue holding rather than blindly waiting to break even. Here is a stock gen picking decision framework you can reuse long gen term. Every time you consider buying a Taiwanese stock, ask yourself these 5 questions. E. What is this company's row for the past 3 consecutive years? Is the trend rising or falling? R. Compared to the TAIEX average, is the current P/E ratio reasonable, high, or low? What is the reason behind this? Sen. Does this company's row come from sustained competitiveness in its core business, or from one-off non-dan operating income, or treasury stock operations? Su. If this stock drops by 50% tomorrow, does my financial situation allow me to continue holding it? Wu. Is my understanding of this company sufficient to judge that its enterprise value hasn't fundamentally changed during a market panic? Only if you can clearly answer all 5 questions should you buy in. If you can't answer even one, don't move yet, do your homework first. Finally, we need to clarify the application boundaries for different demographics. Fei, if you're a student or a recent graduate, your primary task is building an emergency fund, usually 10 to 11 months of living expenses. Before achieving this, it is not recommended to put large amounts of money into individual stocks. You can start by setting up a monthly automatic investment plan into a Taiwan Wushi Dan-related ETF, while taking the time to learn how to read financial statements and check ROE and P/E. Once you have a foundation, you can gradually add individual stock research. Fei, if you are a working professional with a family or a modest earner, you should only put idle funds into the stock market after securing your emergency fund, insurance coverage, and mortgage obligations. The proportion of individual stocks in your portfolio should be determined by your family's financial situation and risk tolerance, not the more the better. The P/E and ROE screening criteria still apply, but you need a more conservative, Diversified allocation. Don't concentrate too much in a single industry. Fei, if you're middle-gen aged, sure to are years away from retirement, your investment portfolio needs to start focusing on balanced asset allocation. You cannot bet everything on highly volatile individual stocks. High-gen quality individual stocks can be part of your portfolio, but they need to be balanced with fixed-gen income assets. The specific ratios depend on your retirement plan. I recommend consulting a legally licensed financial advisor in Taiwan. Fei, if you are a senior approaching retirement, capital preservation and stable cash flow are more important than capital appreciation. The volatility of high-gen ROE growth stocks might exceed your risk tolerance. This demographic is better suited for defensive targets with stable dividend yields and sound financials, while keeping sufficient cash on hand for daily needs. The P/E and row screening logic for individual stocks still applies, but your tolerance for volatility must be much stricter. Let me say today's core mantra one last time: price reflects market sentiment, but value reflects the facts of the business. Making money long-gen term relies on buying the right facts, not guessing the right sentiment. Whenever you want to buy a stock in the future, ask yourself about these two numbers. First, what is the P/E ratio? What percentage is the row? Which way is the trend heading? By getting these two things straight, you've already beaten 90% of retail investors in Taiwan. Not because you are smarter than them, but because you are looking at facts, not sentiment. I'll leave you with one more thought. Stock picking isn't about guessing what will go up. It is about finding companies that won't make you regret holding them long-gen term, even if you guess the short-gen term trend wrong. Leave a comment now and tell me, what is the most useful concept you learned today? Is it the true meaning of the P/E ratio, the importance of the row trend, or the advanced pitfall regarding treasury stocks? Let me know, and I will use your feedback to decide which direction to dig deeper into for the next video. If this video gave you a breakthrough in your understanding, please hit the like button and share it with friends who are still picking stocks based purely on price numbers. Help them take a few fewer wrong turns. Be sure to subscribe because there are more hard truths that Taiwanese retail investors need to know, but no one is telling them. Finally, in accordance with Taiwan's financial regulatory guidelines, I must clarify, all content in this video is for financial education purposes only and does not constitute any investment advice. It does not represent a recommendation for any specific stock or financial product. All investments carry risk, and past performance is not indicative of future results. Before making any investment decisions, please independently evaluate your personal financial situation and risk tolerance and consult a legally licensed financial advisor and tax professional in Taiwan. For information regarding investor protection from the Financial Supervisory Commission, FSC, please visit the FSC's official website.